We'll be talking about basics of banking today. Basics of banking covers the following topics: evolution of money in banking, beginning of modern banking in India, developments post independence, structure of Indian banking, role of the Reserve Bank of India, definition and regulation of banks, regulation of non-banking financial companies, rather we can say NBFCs, banker customer relationship, credit creation, role of banks in the economic growth. First, we will talk about evolution of money and banking, how the banking concept has evolved over a period of time. The concept of banking in India was well known from the early times. The word banking is derived from the Italian word banca, which means bench or counter. People used to assemble at the marketplace with whatever goods they are having for exchange for some other goods. Manusmriti speaks about deposits, loans, interest, etc. In the Hindu mythology also, Kuber is considered as the banker of gods. The usage of Ranapatra is found in the early ages of trade, which shows that a type of banking activity was existed since centuries back. Exchange of goods and services started through barter, and cattle was used as a medium of exchange in the early period of trade. Thus, the wealth of a person was measured by the number of cattle that one person possessed. Later, with the cultivation of crops becoming a means of livelihood, grains were considered as money for exchange of goods. However, with the discovery of precious metals, they became the physical money for exchange instead of the barter system. The coins of gold and silver were mostly used as money in the earlier times. The Lydians in Asia Minor were the first people to use metal coins, which were made up of gold and silver. Later, the stocks of gold and silver, which were largely available in Persia, were converted into coins for easy transfer among the traders. Alexander the Great decreed that 10 silver coins is equal to 1 gold coin of the same weight, which became the first official exchange rate. In China, people use deer skin before the invention of paper money because the coins were very costly. So the people were trying to make money at a lesser cost. Then they invented the paper money. China was the first country to introduce paper money. After the visit of the great explorer Marco Polo into China, he spread the use of paper money in Europe because no other country was using the paper money prior to China introducing the banking system. In the Mauryan period also, there used to be a written document known as Adesha, a type of instrument similar to a check in order to pay a certain sum of money to a specified person. By issuing an Adesha to somebody, it will be clearly mentioned how much amount of money has to be paid to such and such person in exchange of whatever the goods they receive or services they have received. Historians have reported that during the Mughal period also, bills of exchange were issued for local as well as international transactions. Bill of exchange is nothing but an undertaking to pay a certain sum of money only to a certain person in exchange of goods they have received. With the growth of commerce and trade, moneylenders have sprung up as bankers for transfer of money between purchasers and sellers of goods. They were called as sets, shroves or chettiars at different geographical places of India. They used to do the transactions of money. They will lend to the needy persons, either they are agricultural laborers or the household people. These moneylenders used to lend to the agriculture farmers, businessmen and the poor people to meet expenses for marriage of their children and to repay the debts taken from zamindars. Of course, they were charging very high interest rate, which were very exorbitant. These were the early types of banking, but over a period of time, it has changed over a period. You can see the beginning of modern banking in India. Banking in India on Western lines had started at the beginning of 19th century. During the British rule, 3 banks were introduced first: Bay of Bengal in the year 1806, Bank of Bombay in 1840 and Bank of Madras in 1843. They were the first 3 banks established with the financial participation of the government. These banks were given right to issue notes in their respective regions. These 3 presidency banks were later merged together to form a bank called Imperial Bank of Commerce in the year 1921, while Imperial Bank of India Act 1920. But these are only very few banks as compared to a big country like India. The first purely Indian stock bank was the Outh Commercial Bank, which came into existence in the year 1889. It was followed by Punjab National Bank in the year 1894 and the People's Bank in 1901. The Swadeshi movement of 1905 gave stimulus to the starting of various Indian banks like Bank of India, Central Bank of India, Canara Bank, Syndicate Bank, Dhanlakshmi Bank, etc. And so many provincial banks like Bank of Baroda, Bank of Mysore, Bank of Bikaner in Jaipur, Bank of Patiala, etc. Then we will see how the Reserve Bank of India was established. The Reserve Bank of India was established in the year 1935, well before the independence. It was a shareholders bank with a paid capital of 5 crores. It was to act as bankers' bank and it had the powers of note issue. By bankers' bank means it is a banker to all other banks. Wherever they require any excess cash or the banks are having excess cash, then what is required they can deposit with the RBI. Similarly, whenever there is a requirement of cash, they can withdraw from the RBI, and they are the regulator and they had the powers to issue notes. It is a regulator also. Its authority was spread over the undivided India, including the Pakistan and Bangladesh. Prior to independence, all these two nations were also including India, were included in India. So RBI has the full power to manage the banking system in Pakistan and Bangladesh also. It was also a banker to then Burma, presently Myanmar. Now we can see development post-independence. Soon after independence in 1947, Indian banking system recorded rapid progress. As I said earlier, our country is so big and the banking system is only few banks were developed in these areas. So after independence, it has become necessary to introduce more banks as well as for the progress of the country. Industrial development was also much more important. Accordingly, Industrial Development Bank of India (IDBI), Industrial Credit and Investment Corporation of India (ICICI) and Industrial Finance Corporation of India (IFCI) were promoted by Government of India with the sole aim of providing loans to industries for India's industrial growth as envisaged in the first two 5-year plans. Agriculture and industries are the main motives in the first year plan as conceived by first Prime Minister Jawaharlal Nehru. So these financial institutions were essential for the growth of any industry, especially in the small scale sector as well as large industries. The Reserve Bank of India was nationalized in the year 1949 by Government of India. After the independence in 1947, the government thought that RBI should be nationalized. They should have more branches in India. The Banking Regulation Act 1949 came into existence to streamline the functioning activities of banks. In 1955, State Bank of India Act was enacted and soon after Imperial Bank was taken over SBI. In 1959, State Bank of India Subsidiary Bank Act was passed and 8 banks like Bank of Mysore, Bank of Patiala, Bank of Travancore were taken over by SBI as their subsidiary banks.